This meeting is being live streamed, which means this is Value After Hours. I'm Tobias Carlisle, joined as always by my co-host Jake Taylor. Our very special guest today is Robert G. Hagstrom. If you don't know the name Robert G. Hagstrom, you're probably not listening to this podcast, so it doesn't matter. It's probably one of the first books that I ever bought on investing, the Warren Buffett Way, iconic book. Robert says it's just about to be made into a wily investment classic, which seems appropriate. Um, Robert's had a glittering career. I'm just going to read a little bit of his bio here. He's Chief Investment Officer at Equity Compass, Senior Portfolio Manager of the Global Leaders Portfolio, which is coming up on its 10-year anniversary, which we always say endurance and durability is the true measure of performance success here. He used to be Chief Investment Strategist at Legg with Bill Miller, but he ran the growth equity strategy there for 14 years alongside Bill. So lots of great stories from Robert today. But he's also written seven investment books, nine investment books. What are you up to, Robert?
Well, I think we ought to keep it at seven because when you get in
Seven.
the second editions and people say you're cheating if you say that's a new book. So I think lucky. Let's just leave it at lucky seven.
17 translated into 17 foreign languages, investing the last liberal art inside the ultimate money mind, Warren Buffett, and the Warren Buffett way, of course. Welcome, Robert.
Well, thank you very much, Toby and Jake. Thank you so much for the invitation. Good to be with you.
Let's start perhaps right at the beginning. The Warren Buffett way. What inspired you to write that?
Gosh, boy, that takes me back, 3 decades. Before I had studied Warren back in 1984. I had graduated from college at Villanova University and did my undergraduate and graduate in political science, and actually wanted to go to Washington and be the next Woodward Bernstein. I had it in my mind that that would be a great career. Except when I got to Washington, D.C., I discovered just really how gross that place is. It's really disturbing. I'd done some writing in college. I wrote for the Villanova newspaper, started a libertarian society. I was really radical back in those days. And I wrote for the local newspaper called the Suburban Wayne Times outside of Philadelphia. So I took my tail between my legs and went back to outside of Philadelphia in the suburbs and asked the guy that owned the paper. I said, "Boy, I'd really like to have a job. Can I write a column?" And he said, "We can't afford to pay you, but if you go out and sell quarter-page ads on the newspaper, after you've sold so many ads, we'll let you write a column." I said, "Oh, well, all right, that sounds pretty good." So I don't know if you know the history of Philadelphia, but the main line is it's called Lancaster Avenue. It goes all the way out to Lancaster, Pennsylvania, where the Conestoga wagons went west. So I just kind of, started at the county line there and went west, knocking on doors. And, do you want to buy a quarter-page ad in the newspaper? And I ran into something called Legg Woodwalker, members of the New York Stock Exchange. I had no idea what that was. I thought, well, maybe it's a law firm or an accounting firm. I almost walked by, but then I said, you made a promise that you'd knock on every door. And I walked in and told them who I was. They took me back to the manager. He said, "What can I do for you?" And I said, "I'm Robert Hagstrom. Would you like to buy a quarter-page ad in the newspaper?" He said, "No, would you like to be a stockbroker?" I swear to God. And I said, "Well, I hadn't really thought about that. Stockbroker, what is that all about?" And I was dating a young lady at the time who I hope would become my wife. And I thought to myself, well, she might be a little more impressed with a stockbroker than a quarter-page ad newspaper. So I went into training at Legg 3 weeks. Had decided I'd made a terrible mistake, was going to resign. The Thursday night before the last day, we were handed a photocopy of a Berkshire Hathaway annual report, which I'd never heard of, written by a guy named Warren Buffett, which I had never heard of, and was told to go back to the hotel room, read, and we'll discuss the next morning. And so when I got to the hotel room, Toby, I opened it up and instantly depressed. There's no pictures, no tables, no graphs. It's just a long, long letter, And I said, well, this is going to be a long night. And it really was apathetic. It was the proverbial light bulb goes on. And in that annual report, I think that was the 1983 annual report, he starts off by introducing Rose Blumpkin at the Nebraska Furniture Market, and Chuck Huggins at See's Candy, and Stan Lipsey at the Buffalo Evening News, and Jack Byrne at Geico. And he just began talking about all these companies and these managers and all these people. And it was really one of those things where I couldn't understand balance sheets and income statements. And it just made no sense to me, but I could understand people and products and services. And so I finally, I said, okay, I got it. And I went back into production, and all I did was do exactly what Buffett said. I just, I wanted to buy good companies and hang on to them. In those days, if you sent a $25 check to the SEC, they'd send you a photocopy of the Berkshire Annual Report. So I had all of them. I had all the companies that Warren invested in or read the annual reports. And so that's how I was as a stockbroker. My manager came up to me one day and he said, you're going to starve to death if you don't ever sell something, because in those days it was a commission business. I said, well, that's not how this works. We're supposed to buy and hold. And, it was obviously, I needed to get to the buy side. I worked to a bank trust department, onto a money management organization, got my CFA. And in 1992, the CFA said, they changed their performance presentation standards and said, if your performance is, for you to publish your performance, and that must be 100% discretionary. And I said, we're in trouble because these aren't discretionary accounts. People would say, this is my favorite stock, and my son wants this stock, or I have a tax issue. So none of our accounts were discretionary. I said, we've got to start a track record. My partner said, what do you want to do? And I said, well, let's do this Buffett thing. And they said, I'm up to here with you and Warren Buffett. That's all you talk about. That's all you're driving me crazy. And so I wrote a white paper. They said, write a marketing paper on it. I wrote a white paper on what I thought was the kind of the methodological approach to investing according to Warren Buffett. That turned into a book proposal that ended up with a guy named Miles Thompson at John Wiley & Sons, and that became the source of the book. So once again, came in the back door when nobody was looking. And that's how the book, 10 years later, that's how the book got its lift.
What is the Warren Buffett way in the book, The Warren Buffett Way? What's your conception of it?
Yeah, it is, and Warren has talked about this, and I try to, I say it to my, my clients and to, our investment seminars and my writing. I said, there's a very big difference between being a stock picker and thinking about stock markets, and what Warren says, being a business picker. and even though those differences may be subtle in your mind, they're really huge when you parse out how people think about things. So if you kind of go back, Warren's favorite book, The Intelligent Investor, if you go back to the beginning of that book, Ben Graham says, the minute that you purchase a common stock, you've got two choices. And the first choice is you can perceive yourself as being a business owner. You're actually, you buy 100 shares, 10 shares, you now own, you're a part owner of this company, and you can behave as an owner, as an owner would behave if they owned this great business. Or you can think about it as a piece of paper that you can trade and flip around and make speculations and interest rates and sectors and stuff like that. Because you're going to do one or the other. And what Warren did, basically, as he became the controlling owner of Berkshire Hathaway, really ingested the idea of being a business owner. And he basically grew Berkshire Hathaway as a collection of businesses. Some were private and a lot were publicly traded companies, but he treated them all the same. And there's a profound difference, Toby and Jake, profound difference between the attitude of someone who thinks they own a business and someone who buys a stock and begins putting portfolios together and changing portfolios based upon stock theories and interest rates and inflation and all this stuff. It's a totally different game. And so the Warren Buffett way is about how to invest in businesses. The benefit is you got this public market that's got a huge menu of some really great companies with great economic returns, with great managers, and it gives you the opportunity to become an owner of these companies. But you have to put on your blinders and your earmuffs sometimes and divorce yourself of the stock market. Somebody asked me, what do you think is Warren's competitive position, his competitive advantage? And I think I finally came up to the resolution is that he purposely, it's underscored purposely, he purposely disengages from the stock market. He doesn't care about the stock market. When I talked to his secretary, Debbie Bazanik, I said, does he have a TV? Does he watch CNBC? He goes, oh, yeah, he turns it on every once in a while, but he has the sound off. He never listens to it. He just looks at it as a tape, if there's new headlines. It's his purposeful detachment from the stock market that I think has led to a lot of his success. And then the second layer was he both simultaneously owned companies, private companies, like See's Candies and the Buffalo Evening News and National Indemnity and all that. At the same time, he was owning public companies, Washington Post, Cap Cities, on down the line, and he treated them both the same. And in doing that, I think that's what led to his great success, because in conclusion, I think the mistakes that people make in investing is doing things that are not highly predictable. You cannot, even though we say you cannot predict the market in the short run, that's a fact. Science, there's no science yet that can predict the market in the short run. And you do all these things that are unpredictable with low probability outcomes, and people go, yeah, I know, but they still do it anyway. And so it's a lot of unforced errors that people do by being stock owners, stock traders, that a business owner doesn't have unforced errors. You know, they basically are buying, hold great companies. And if you do that over time, you know, you get some pretty good numbers. Whereas if you try to be a stock trader, you're going to have a lot of error rates that take away from your returns. I know that was a long-winded answer, but that's kind of how I think about
it. The book brought you to the attention of Bill Miller. Is that the way that it worked? And then
Yep.
he invited you to run the growth equity,
yeah,
which is a funny leap, because Buffett, you say Buffett's one of the great growth investors.
Yeah.
Bill was there running the value fund, and he's a pretty growthy value guy as well. So how did that come about, and how was that?
Well, you know, my relationship with Bill Miller goes back to when I joined Legg Mason. Bill was director of research. This was about the time he was starting the value trust with a guy named Ernie Keeney. When I was there, I think it was a year or two old. And Bill, as you know, I don't know if you know much about Bill, but phenomenal guy. You know, he was a baseball pitcher, Washington Lee. I think he graduated with honors in economic history and European economic history. He went into military intelligence for 4 years, so he wasn't going to, he could pick where he was going to have to sit out the Vietnam War. Then he went right into philosophy, and he did his graduate work in philosophy, absent the dissertation, at Johns Hopkins. So a very well-read individual, very, very smart individual. And Bill would do Tuesday morning research conferences over the Squawk Box, which were actually Squawk Boxes at that time, not the name of a CNBC show. And he would always talk about these books that he was reading, and I would actually, go and try to track them down. This is before Barnes and Noble and Amazon, and some of those books were quite eclectic. And I would call him every once in a while, and he said, Robert, you're about the only guy that ever went out and bought these books, much less, called me about them. And I said, well, I guess maybe just curiosity killed the cat. So anyway, we had a nice 10-year relationship. And then when I wrote The Warren Buffett Way, my argument was that, I did think that Warren had become a great growth investor. Because if you go back and think about Coca-Cola in he put $1 billion in it in 1988, 1/3 of the portfolio. It was trading at a PE that was a premium to the market, price to book premium to the market, dividend yield below the market. And he put 1/3 of his portfolio in it. And the stock was growing. If you look at revenues and earnings, it was growing faster in the market. And everybody had lost their mind. They said, Warren, what are you doing? You're turning your back on the master. Ben Graham would have never bought this stock. Well, in the next 10 years, $1 billion turned into 10 billion. And $1 billion in the S&P 500 turned into 3 billion. So I would say, well, that's a pretty good value purchase. If you buy something that goes up 10 times and the market goes up 3 times, it must have been mispriced. And what he had done in 1992, and we captured it in the book, is that he, finally came around to pivoting from, it's not low PE, low price to book, type accounting treatment of stocks. It is the cash returns on businesses. And he introduced John Burr Williams in 1992, and he said, it doesn't matter if it's a high PE, low PE, high price to book, low price to book, dividend yield has nothing to do with it. It's all about the discounted present value of the future free cash flows. And we try to buy those coupons at a discount. So when you go from there and you get to Cap Cities, you get to American Express, and you keep moving down the line, he was buying blue chip growth companies, not tech companies like Bill Miller ended up doing, but he was buying companies that were growing faster than the average market, and he was buying them at a discount through the DCF model, and he was making a ton of money. So Bill called and said, he was expanding his lineup and wanted to go into the institutional business, said, do you want to run a portfolio like Buffett does and do the growth trust? I'll do the value trust. And that's how we did it. I ended up with 7 billion. He ended up with 70 billion, which is what you get when you beat the market for 15 years in a row. That's a pretty good track record.
Hey, Robert, with today now, I think it's fair to say that the kind of quality approach is a little bit, it's not a secret to anybody, right? Like everybody wants to own quality companies. How do you tell when you're overpaying for a quality company? And then two, how can you tell if someone else has the ability to find the next Coke or not? Because I think it seems like it's really difficult to know if a business is going to be better in 10 years than it is today.
Well, and Toby, bullseye. So if you ask Warren, what were the mistakes that you made in your career? And he says, well, the mistakes, that I've made in the past are, that, I misread management. Management ended up doing something that I thought they wouldn't do. They misallocated capital. That I overpaid for the business. I rarely do that. He goes, the mistakes that I made most of all was mispredicting how long this business could be a great business, right? And so if you're a buy and hold Buffett guy, your bet is that they can continue to generate cash, earn above the cost of capital, take that cash back into the company, compound it, and do it over a long period of time. So the other tenets are things like favorable long-term prospects. You're trying to make a judgment how long somebody can do this. And then it is, Buffett saying, I want a moat, a franchise. And that's nothing more than saying, I want a company that continues to be the leader and will continue to be the leader despite the fact people are nipping at their heels, trying to take their business away. I want this to be the lead dog, and I think this will be the lead dog for, 5, 10, 15 years. So when I buy a company, and I think I've got a pretty good bet, the first thing that I'm always looking at, once I understand the economics and I understand the industry, things like, I'm just looking at the competitors. I'm like, I look to the left and to the right and I said, who's going to take me out, right? Who's going to take my business away from me? And so we probably spend more time, Jake, on thinking about who can do this better than we can. And so I keep a sharp eye on the economic returns of my competitors. And if they're starting to creep up or my returns are starting to creep down, then that's nerve-wracking that you think, okay, there's that. But if you've got something that's working really well and nobody is able to take it away from you. So, Bill and I bought Amazon. We were at the IPO, which was a good time to buy it until 2000 when it was down 80%, although Bill still has $9 Amazon stock in his portfolio. It was very clear to us that Jeff had a business that was going to be very difficult for anybody to take it away from him, being the low-cost provider of quality items. And so you looked at left and right, Walmart, Barnes and Noble, stuff, they couldn't take the business away. Google, same type of thing. When we had that one figured out, nobody could do search better than Google. So you're always looking at what do you own, and is there anybody that's close nipping at your heels? And that's where we think if we've got that part right, we can ride the bumps. One of the studies, I don't mean to go too long, Jay, is that we're looking at these 10-year outperformers, right? But we're looking at drawdowns, not the drawdowns of the super events like the pandemic or when the Fed raised interest rates, 5 percentage points in a year, everything cracked, particularly in the growth market. But how many times these great growth companies have drawdowns of 20% or more? And it actually happens a lot. Mm-hmm. And so it really becomes, the art of investing long term is really the art of not selling. And that's a term that came out of Acri Capital Management and one of their PMs there that wrote it up.
Chris Cerrone. That's great.
And he was brilliant. It's a brilliant thing that it said. And so Lou Simpson said it in a slightly different way. He says it's not hard to pick the great businesses. The difficult thing is hanging on to them. And so I'm not sure I hit the bullseye on your answer, Jake, but it is if you got a good company because you've got the returns, return on capital, they're putting it back to work, favorable long-term prospects. It's just looking left and right, thinking, can anybody take you out? And that's what we spend a lot of time on. Can I give you one great story?
Yeah,
this
please.
Was actually
always.
Who wrote that? God, I'm having Morgan Housel, right? He wrote The Psychology of Money. Well, his new book said something like something's never changed, and I
Same as it ever
apologize.
was. Yeah.
Yeah, thank you. So he tells this story, and this is perfect, right? So right after the financial crisis, Warren he's driving his Cadillac, and he's got a reporter in the company, and it's 2009, and the reporter's down in the dumps like, oh, Warren, this is horrible. Banks are going out of business, and the worst recession since the Great Depression, the banking system crashed. And Warren said, what was the best-selling candy bar in 1962? And the guy said, I don't know. He said, well, what was the best-selling candy bar? And Warren finally had to tell him, Snickers.
Snickers, yeah.
Yeah, and then, so they were driving on, and then he turned to him and he said, what's the best-selling candy bar today? And the guy said, I don't know. And he goes, Snickers. And the conversation ended. There's the whole essence of the Warren Buffett way. You're trying to buy a Snickers bar today, it's going to be a Snickers bar 10 years from now, right? And that's kind of how we think about it, you know. So once again, I don't know if that hit bullseye, but that's kind of how I think of it. I'm looking for a Snickers bar today that I think will still be the Snickers bar 10 years from now.
Let me give a shout out. Mendocino, California, Toronto, Petah Tikva, Israel, Havertown, Pennsylvania, Vestavia Hills, Alabama, Valparaiso, India, and what's up, Mac? Sydney, Nova Scotia, Katowice, Poland, Holstadt, Austria, Santo Domingo, Kennesaw, Georgia, Camas, Tallahassee, London, Cromwell, New Zealand, Istanbul, Turkey, Lulair, Sweden, Philly, Seattle, Jebel Ali, Dubai, Milton Keynes, York, UK, Houston, Texas, Japa, Nepal. I think I've got them all.
I've started studying geography a little bit more just because I always feel so dumb when you do this and I don't know where 3/4 of the places are.
Gotta do it in the after.
I have a question, Robert. A friend of mine asked me to ask you specifically about business-driven investing.
Yeah.
What is that? And
yeah, I've run with that term over the last couple of years here at the Global Leaders Portfolio, and basically the subcontext is if you're a business owner, like we were talking earlier, Jake, everything that you see through the lens of a business owner is how you would think about the company, portfolio management, and better yet, you wouldn't be thinking about the market, you wouldn't think about interest rates, inflation, and you just wouldn't be making all those bets. So I did a lecture, actually a TED Talk, one of those 15-minute TED Talks with Guy Spear at the Value X conference at Berkshire in 2024. And it was on business-driven investing. And the idea being we were started by trying to answer Charlie's question, which he raised at the 2017 annual meeting. He said, evidently what we're doing here at Berkshire Hathaway works out pretty well. It's been pretty successful. But I'm really kind of amazed, that these prestigious institutions, whether it's universities or other money management organizations, just don't seem to imitate us, And he goes, if we're so right, why are so many other places wrong? And I always thought that was a brilliant, question, right? And there's some Buffett people out there, you know them, but as a percent of the total money under management, it's a minuscule, right? And so we went through the lecture at Guy Spear's conference, and we had to go back to first movers. Anytime you get into one of these historical questions, you got to go to first mover. And it's really interesting. We talked about Markowitz, Harry Markowitz. So he gets a Nobel Prize, and, that's a big deal, right? But if you kind of go back to, you kind of go back 42, he, went to University of Chicago, graduated 46, ended up going to he was a liberal arts major, goes into the graduate program at economics and proceeds to write a paper called Portfolio Selection. And, he'd never been in the stock market, never owned a company, never been a business investor, but was fascinated with the concept of risk and return, was going to apply it to the economy, and changed it to the stock market. And he goes about saying it was really an unremarkable paper, 14 pages long. There was only 4 pages of text. The rest were graphs and mathematical formulas and things like that. And he basically just took it upon himself. He said, thinking about risk and return is the yield on the investment. Okay, I'm okay with that. The coupon, the yield, I get that. And risk is, in his mind, was variance of return. And I said to myself, okay, wait a minute. If this is 1952 when the paper came out, evidently he didn't read Security Analysis in 34. He didn't read the second edition of Security Analysis in 36. He happened to overlook The Intelligent Investor that was written in 1949. He didn't mention the Security Analyst third edition in 1951. He just basically took from the sky, I think risk is variance of return. And so that became the backbone of what today is modern portfolio theory, and that's the standard approach. Well, Warren's approach, what the Warren Buffett way is, a business-driven investing, where everything that you do, from stock selection to portfolio management to monitoring the progress of your companies, is all from a business manager's perspective. So if there were no stock market and there were no stock prices, how would a business person end up judging the progress of their investment? Pretty much the same way any private owner would. What are my revenues year over year? What are my margins year over year? How's my cash doing year over year? They might think about their cost of capital if they borrowed money from the bank, and am I earning a rate of return higher than my cost of capital from the bank? They would look at their economic returns. And as Warren says when he introduced the concept of look-through earnings, and we talked about this in the lecture, if your look-through earnings are progressing at a 15% rate over time, very likely your stock price is going to increase at a 15% rate of return over time. It'll be lumpy, but it's amazing how, the prices, as Ben Graham says, it is a weighing machine, and that's true. So we just basically think as a business-driven investing, we're just basically looking at everything from a business person's perspective, stock selection, portfolio management, and judging the progress of the economic returns of the companies that we owned. And oh, by the way, there's a price over here. And, there's your quarterly statement. And, so I was saying to Toby, I said, our 10-year number's coming up. It's going to be a very good number. We've underperformed the market over the last 10 years on a quarterly basis 50% of the time. On a month-to-month basis, 50% of the time. On a year-to-year basis, I think we've won 6 years, lost 4 years. And you say to yourself, geez, Robert, you've got a 10-year record that crushed the market. You've got a 5-year record that crushed the market. You've got a 7-year record crushed the market. And you're only outperforming 50% of the time. What's going on? Well, it's the difference between frequency and magnitude, right? Slugging percentage and base hit. It's not how many times you beat the market, less how many times you lose. It's how much money you make when you beat the market, less how much money you give back when you don't. And so if you look, our upside capture is really good. I mean, when we get it really good. And our downside capture, because we're value investors, we're just not giving back much when the market goes down. So if you look at the market rotates during different sectors, different stocks, and it moves on and on and on as there's short-term traders and speculators doing that, and I'm holding a pat hand. So when the sun shines on one of my stocks, we get a good lift. And when the sun comes off of it, we come down, we just don't come down as much. And so what I'm trying to get my people to understand is, the market's going to bounce around for a lot of reasons that we can't predict, and I'm not going to be the dog chasing the tail that never catches the tail. So let's own good businesses, and I will tell you the progress, the economic return of our companies. And if that's satisfactory to you, then you should, basically hang in there. The conclusion to the talk was this really is a private equity approach with public securities. If you think about it, how does a private equity manager report to his owners? They have no stock price, so what do they report?
Sales. Whatever they want.
Sales, earnings, margins, whatever. They do have this clever way, which is their NAV never changes, right? The NAV starts as like $1, and for like 3, 4, 5 years, it's $1.10, $1.05, 97 cents. So they have no variance of return, which makes everybody upset. They just motor along, and then the 7th year, it magnanimously goes up 3 times. But basically, during that period from start to finish, T1 to T10, they report sales and earnings and margins. I said, well, why can't we do the same thing? Just because we're a public stock price, why do you force us to play by different rules? Why can't we play by their rules? And so that's what I said. Business-driven investing is basically private equity with public securities. And it got a good rap. There was a lot on social media, and we're talking to some people and try to get to Morningstar, SEI, and rest of those guys and say, hey, you slice and dice the world between value, core, and growth, large cap, mid cap, small cap, and, all this stuff. Well, why don't you segment some of us over here that we're concentrated, low turnover, business-driven guys, and let us have a separate space that has different rules, and let's see how we do head to head. And, we'll get back to you. I don't know what the appetite is, but what I also said is, I don't know if you heard of SPIFA, Standard & Poor's Indices versus active managers, right? So the 2023 numbers came out. You look at the largest sector of the market, which is large cap stocks, basically going against the S&P 500. Over 5 years, 79% of the portfolio managers underperformed the market. Over 10 years, it's 87%. As I said, I know of no sector, no industry, no collection of businesses that would continue to allow the perpetuation of a model or process that fails so miserably and allows these guys to stay in business. I mean, the 20% that are outperforming in good old Adam Smith capitalism should have eaten the lunch of the 80% that underperformed the market, and they should end up with all the money. But it's amazing to me the money management industry continues to perpetuate a process and a portfolio strategy that basically underperforms over the long term. But they win over a quarter and they're heroes, or they win over 6 months, or they're the best this year, but then they fail over 5 and 10 years. So anyway, I'm preaching too much, but that's what business-driven investing means to me.
Yeah, well, this is the church of that, so you're fine to give a sermon.
Why do you think? Why do you think so many investors fail to follow the precepts of Buffett? Is it behavioral, and is that why you've written the mindset book?
100% it's temperament. I've never met anybody who disagrees with the Warren Buffett methodology. When I say, look, this is how he does it. These are the companies he buys. These are, I have the 12 tenets. This is how we're going to, this is the litmus test. If they meet these tenets, we'll put them in the portfolio. We're not going to do a lot of buying and selling. We're going to compound long-term capital gains over time. We're going to tell you about the economic returns. They're like, yep, Robert, where do I sign? I'm in. That's great. And about 3 out of 10 in a month will call me and go, how come we don't own oil stocks? Oil stocks are going up. Wait a minute, that gold is going up, Robert. We need to sell this and we need to buy a gold. I think they just psychologically have this insatiable need to be correct all the time. And I said, you are correct. Look at what you own. Look at the revenues. Yeah, but the prices go up and down for a lot of different reasons. It has nothing to do with the underlying long-term economics of your business.
Have you looked at your Sharpe ratio?
Yeah. You can give them all this, right? You can give them, our returns relative to volatility. They just can't help themselves not wanting to be in what's working. And when it's not working, they just have this jealous streak, like, what you own right now, Robert's not performing. You underperformed for the quarter, you underperformed this year, or you've underperformed 2 quarters in a row, whatever the case may be. It's over here, Robert, you're stupid, you're not buying this. And so Bill Ruane said to me one night after I wrote The Warren Buffett Way, he said, Robert, I met him at the baseball game. It used to be the Berkshire meetings were on Monday, and the baseball game was on Saturday. And Warren would go out and throw the first pitch. And then you go to Borsheim's Jewelry on Sunday, and then the meeting was on Monday. Then the meeting got so big that the mayor of Omaha said, can you move it to Saturday? You're causing so many traffic jams. So I was at a baseball game, and Bill Ruane, the famous portfolio manager at the Sequoia Fund, and he went to school with Warren. And I had never met him before, and I introduced myself, and he, congratulations on the book. I said, thank you, Mr. Ruane. It's a testament to Warren. I said, congratulations on everything that you've achieved with Sequoia Fund. He says, Rob, I'm going to give you a piece of advice. I said, Mr. Ruane, yes, sir. Whatever, got the piece of paper out. I'm, taking notes and everything. He says, you're not going to take this advice. I said, Mr. Ruane, I assure you, whatever you tell me to do, I will do this. He goes, no, you won't. I said, yes, I will. I promise. He goes, you've got a good book. You've got this. You're growing your money management practice. You're going to find out, though, that 2, 3, 4 people out of 10 are going to be a real pain in the butt. I want you to fire them. I said, okay, I'm going to fire them. He goes, no, you won't. You're not going to fire them. They're giving you fees. They're paying your mortgage. They're putting your kids through school. You'll sit there and try to convince them until you're hoarse and out of breath, trying to preach them to come to the church of Warren Buffett. There's some people that don't get it. I want you to cut them loose. And I think he was right. I think there's and I've done this with a few people where I've said, look, I know you really want to do this, but it's just not a good fit for you. And when you take it away, then they get real panicked. Wait a minute. Whoa, no, don't fire me. Don't fire me. But it's a psychological mismatch. Some people get it, and they understand the relationship between stock, business economics, and long-term returns. And when that lines up, when the planets line up, they get it. And there's others that kind of understand the mathematics of it, but psychologically, you know, they just can't get there. Can't get there.
Should we
So,
do veggies at the top of the hour, JT?
Absolutely. So knowing that Robert was coming on, and you know, one of my favorite investment books was one that he wrote here, and it's Investing the Last Liberal Art. And of course, the veggie segments are always they try to be an attempt at multidisciplinary thinking. So I've been saving this one for a little bit for Robert, just because I thought he might have some interesting comments with it. So this is really it's a little biography of Isaac Asimov and creativity, and it comes from this essay, How Do People Get New Ideas? And it's this kind of thought-provoking piece that explores the creative process and the factors that contribute to the generation of innovative ideas. And a little shout out to Joe Koster for sharing this in one of his links on his regular Value Investing World, which is a terrific resource that you should probably all sign up for. If I was smarter, I would just delete Twitter and only read what Joe sends out, but for some reason I can't help but touch that third rail. So a little bit of background about Asimov. He lived from 1920 to 1992. He was a renowned author, professor of biochemistry at Boston University, and an absolutely prolific writer. He wrote or edited more than 500 books and sent out an estimated 90,000 letters, which that's kind of hard to, I try to wrap my mind around what that means per day. But he's best known for his science fiction works, of course, including the Foundation series and the Robot series, which is something like 37 different books. However, he also wrote extensively on other topics like science and history and literary criticism. And this essay that I'm referencing was written in 1959, and it's his contribution to a project on creativity that was commissioned by the U.S. government. So here are his insights. The first thing is that oddly enough, the generation of creative ideas is never clear, even to the generators themselves. A lot of this happens just completely by accident, which kind of makes me wonder. You know, we spend all this money as a society on like corporate R&D. And really, I'm wondering if it might be better, you know, a better way to explore that kind of hidden frontier of innovation might be like, what if we just kind of liberally splayed money around and sent everyone $10,000 who promised to tinker in their garage with it? What might emerge from that? But I'm digressing a little bit. The crucial point of this innovation is that the ability to see these cross connections that aren't obvious, and creativity thrives on uncovering these unexpected connections between disparate ideas. And Matt Ridley, who's also one of my favorite authors, said that innovation is basically what happens when ideas have sex. And creative people tend to have this strong background in their field of interest, but they also exhibit very unconventional habits, and they're often seen as eccentric. It takes a certain level of daring and self-assurance to defy the norms and pursue an unconventional path, like Robert has done with business-driven investing. There's another big part of this is isolation is important for the creative process. It allows the mind to freely shuffle information around without the inhibition from others. And because oftentimes creativity can be embarrassing. Asimov says in this essay that for every new good idea you have, there are 110,000 foolish ones, which you naturally do not care to display. And it's kind of hard to tell what's what when it's just you sitting there thinking. And this shuffling happens even when one is not conscious of it. There's this famous example of a scientist named Kukul, I believe his name is, who worked out the structure of benzene in his sleep. And is that, Toby, I don't know what you dream about. Is it chemical formulations? Benzene. Yeah. So Asimov says that it's necessary for all the people at a session, like a creativity session, to be willing to sound foolish and listen to others sounding foolish and not judge them. And a collaboration could go wrong if a single person has a greater reputation or is more articulate or has a more commanding personality. And the rest of the participants can then kind of be reduced into these passive obedience. And innovation will be squished even if the high repute person is really talented. Asimov ventured that the optimum number of the group would not be very high, maybe no more than 5 people. He says that joviality, joking, and kidding around are an essence of this because they encourage a willingness to be involved in the folly that is required for creativity. And then lastly, you should have like a facilitator to play a role of guiding the discussions and prompting deeper exploration and ideas. And it's important that person then asks shrewd questions and then can kind of steer the session back on point when it gets too far off. So I thought it would be kind of interesting to put together like what would maybe be a if you're an investment team and you wanted to take some of these insights from Asimov on creativity, what might that look like? So this is for like a kind of incubator idea. Pick an unconventional venue like a museum or a botanical garden or maybe a remote cabin or an art studio, something, and utilize the elements of isolation and subconscious thinking to generate novel ideas. So here's a possible format. Like maybe you start out with meditation and visualization, and then gets everyone relaxed and kind of a free flowing ideas, and then go off and do individual quiet time for each person. So maybe it's a walk or just, walking around the museum or art gallery, letting your mind wander, jot down any ideas that come to mind, encourage free association and stream of consciousness writing, and then get together and share the wildest and most unconventional ideas in a safe, non-judgmental environment, and then collaboratively build on those shared ideas and connect disparate thoughts into maybe novel strategies and ideas. And just for fun, I have my own silly idea to share. It's something that I've had on my like little list of things that if I had more time and less, probably if I didn't have kids, I might have already started working on this. But it's called multidisciplinary. Name to be determined. Not that great, but so imagine a multi-sided dice, a set of multi-sided dice. And each side of the die represents a mental model of some kind. And something like, invert or the theory of evolution or inertia or alloying, which is like combining a substance to form something even better, or the prisoner's dilemma. There's all these mental models that you can find in Robert's book that help. So what you do basically is like roll the dice, and now you filter your problem that you're thinking about through two different mental models. So you're kind of like working on two or three even. I mean, two might be the max that I could come up with, but and see if anything interesting emerges from filtering a problem through these two mental models at the same time. And you'll instantly have this lattice construction of mental models. And maybe this might be better done as an app or something. I don't know, but I kind of like the physicality of the dice in the real world to create to foster more creativity. So it may be like you feed your problem and your two mental models into ChatGPT and see what it says. But I kind of would say like don't shortchange your own creativity there. Like I think these robot overlords at some point, they're going to have probably the $1 million ideas, but I think yours is still going to be the $1 billion idea. So anyway, I like this idea of kind of taking advantage of mechanical randomness of the dice to ask the universe to whisper its serendipity in your ear. So anyway, Robert, what do you think about? You ready to go build multidisciplinary?
Jump to conclusions.
First of all, well done, Jake. And I think you've hit on something that we talk a lot about at the Santa Fe Institute. Bill got me involved in the Santa Fe Institute, which is the study of complex adaptive systems. And there was a professor there named John H. Holland, who was a computer science professor at Michigan. And he wrote a book called Emergence and Hidden Order and things like that. But he was basically saying the same thing you were saying, Jake, about how new ideas, it really is a balance between, exploiting what you already know and exploring what you don't know. And it is random, right? So, he talked about how the Norwegian fishermen were really quite successful fishermen for so many years, and they tried to figure out why, and they said, well, they had this, seaman out there that basically would just randomly tell them to go into different directions, and they would ultimately find new schools of fish. Or the medicine men from the Indian Navajo who would say, well, the buffaloes, he'd roll the bones out on the floor there, and he said, well, the buffalo are over there. But it is what you were saying, which is exploring for new ideas. Is you've got to go hunting in different areas that are not comfortable to you. You don't want to spend all your time exploiting what you know. You'll never explore for new ideas. So one of the famous jokes that they tell at the Santa Fe Institute was this guy coming back from the pub late one night and obviously had too many Guinness beers, and he was stumbling back and forth and had his keys and his key ring, and he stumbles and the keys go flying off into the dark. And the constable was rocking by and helped him up and said, well, I'm sorry, let's try to get you home, and he goes, I got to find my keys. And he walks underneath the street light. And the constable says, what are you doing? He goes, your keys are way over there in the dark. He goes, yeah, but this is where the light is. And so he'd only look for his keys under the light. And I think we have a tendency to continue to exploit what we already know because it's under the light that we can see. as opposed to what you said, Jake. And it's almost random, just go hunting for new ideas in different disciplines and strike a balance between exploration and exploitation. And I think you can cross-reference that in Investing the Last Liberal Art. I think we have that reference in there. So kudos to you. That's the way creativity works. And it works by analogies and metaphors, that once you go into the dark and you come up with new ideas, oftentimes you go, it looks like this, which is similar to what's going on in the markets, or whatever the case may be. And
Robert, maybe you could tie together, ants, a certain number of ants in a colony will have, they're programmed to not follow the other ants. And so there's slack in systems. And maybe talk about Buffett's slack in his systems that allow for the emergence.
Yeah, I don't know if I would count Warren as one of those emerging characters. He's always been somewhat, he's not like a Charlie Munger. Charlie would pick up books that would be random, and Charlie would be more of kind of the emergent property. But, E.O. Wilson and the Concilian Observer and stuff like that, getting ideas. And he was one who studied the ants. But it is amazing, the ants, just like the hunters of the Navajo Indians and the fishing fleet in Norwegians. They would take off in direction. They wouldn't follow the pheromone trails every day. 3 or 4 or 5 of them just would turn left or turn right and head off. And inevitably, they would find some new food, and then they would come back, and there's the new pheromone trail. And so when I talk to students and stuff like that, and of course they're so immersed in just trying to get their grades done and finish the semester, the idea of adding one more additive of reading to that. And I said, well, do it over the summer. But I always tell them, don't, if you're in the finance world, don't go spend the summer reading economics and finance textbooks. Go read some philosophy, go read some psychology, go read biology, go read, anything, sociology. Go tapping in for new ideas in different places, and it will inevitably make you more insightful. What did Charlie Munger say? The man with a hammer, everything looks like a nail, right? If that's all you have in your toolkit is a hammer, and your finance and accounting, well, then everything looks like you're going to solve it by finance and accounting. Or as Charlie more colorfully said, it's like being a one-legged man in an ass-kicking contest. You're just not going to get very far. You're just not going to get very far.
Robert, what's the writing process for you? How do you know that there's enough meat in an idea? And have you had any proposals that you sort of got into and thought, no, there's not enough here?
Well, yeah, that's typically, if I come up with an idea,
self-interested question here, Toby.
Yeah, no. This is God's honest truth, and there was a How to Do It bookstore on Sansom Street in Philadelphia, and I've told the story before. And you go how to fix your refrigerator, or how to fix the roof, or how to fix plumbing. And one day it was a very skinny book that said how to write your first nonfiction book. Now, Toby, this is nonfiction, not fiction, which I have no talent, no art. I tried to write a fiction short story one time, and I destroyed it and burned it before anybody could see it. I don't have that gift. I'm not of that mindset. But it said, have you ever written a 20-page term paper? I said, yeah, And I said, yeah, I've done that in college. And then the second page was, have you ever gotten a B or better? And I thought, well, I didn't get that many good grades, but I think I had a couple that got a B or better on it. And then it said, can you write 8 term papers in a year? I said, well, crap, I used to do 3 in the last month of the semester. So yeah, I can do 8
like
term
the night
papers
before, really.
And so a book really then becomes, can you string together, 6 to 7 to 8 20-page term papers? And so a book really is something that has enough meat, and because you're telling a story, and so you have a storyboard, and you put up what are the main topics that you want to cover in your story. And is there enough meat that you can get 20 pages of insightful comments on that? And then when I sit down to write a book, Toby, I never think about writing a 300-page book. I just think about this month I'm going to write a term paper. And over a year's period of time, I can get eight chapters done whatsoever. And then you got to clean it up and you send it out for reading and stuff like that. But you start with a storyboard. 6 to 8 ideas that you want to translate, and then you have to figure out, is there not, like you said, is there enough meat on the bone here for a 20-page term paper? But I never think about writing a book. I just think about writing a string of term papers, and there have been ideas that I thought could have snuff, and you just got to let them go. If they don't meet out, you just got to let them go. but having said that, what I never did, and I wish I had, is I wish I could have written more articles for magazines. I really got stuck up that, I was only going to write books. I should have written more, guys like Michael Lewis, really good writers and stuff like that, they'll peel off and do something for the Atlantic or the New Yorker or something like that. And so sometimes if you don't have a book idea, you might have a really, really great magazine article idea that can get a lot of track record on you.
I was wondering if it was a good way of preventing you from meddling with the portfolio.
Yeah.
Well, I'm not trading every day. I might as well do something, right?
Can we talk a little bit about investing? That value had a particularly rough run over the last decade. I don't know, it depends on when you measure it, from 2010 to 2020 or 2015 to 2020. Did you experience any of that? And how did you deal with that?
No, I don't think value ever has a rough period. I think there's always things that are mispriced in the market. And sometimes they will show up on the traditional value ledger of low price earnings, low price. Remember, the world divides value and growth between these accounting metrics. And sometimes they get play and sometimes they don't. Now, one of the things that I found interesting in my research and research at Equity Compass is the typical value stocks, which are low price earnings, low margin, capital intensive, low price to book stocks, typically do well from the bottom of a recession to the peak of the expansion because they need animal spirits. Typically, classic value stocks will outperform classic growth stocks when the economy is growing above trend line. So let's say we're in a, real rate of, the average real rate of return of the economy, sustainable growth rate of the economy is, let's say, 2.5% real, whatever the case may be. The economy is growing 3 or 4. Typically, the low margin, capital intensive value stocks gear real well. They typically perform real well. Growth stocks, though, typically outperform at the peak of the economic expansion down through the recession. When growth is decelerating and the growth stocks can continue to motor along because they have products and services that are in high demand, so they're not seeing a deceleration in their growth and earnings, they typically do well from the peak of the expansion down through the recession. You get down to the bottom of the recession, the economy takes off, the economy is growing 4, 5, 6, 7%, growth kills value. That's often the way that it happens. And so when you kind of look back, we've kind of had this muddled period where we didn't really have, hyper growth in any one of the cycles until post-pandemic when we put $4 trillion to work. And then all of a sudden we got 7 and 8% real GDP growth, and boy, value stocks took off, right? So I think there's always, and Bill Miller was really good about this. He was never enslaved to anything other than what was mispriced. He was just looking for mispriced. And sometimes it showed up in technology stocks, and sometimes it showed up in airlines, and sometimes it showed up in commodities. And he's very, very adroit at being able to sniff out where mispricing is, which is, all in, as they say, all intelligent investing is value investing. There's something mispriced in the market. You just got to go figure that out.
Robert, do you have a sense of what he would say about why was Bitcoin mispriced?
Well, as you know, Bill made a 1% bet of his net worth, almost 15 years ago, which turned into $1 billion return.
Yeah.
And so it's interesting, when I talked to him about that, he said it really wasn't a hard bet for him to make, because he said, now a 1% bet for Bill Miller's net worth, I would have choked to death thinking I'd lost that amount of money. But for him, like you said, if I lose 1% of my net worth, it's not going to change my life. It's not going to change my lifestyle. He thought that the idea of it was sensible. And he did say he was going to ride it long term, no matter what. I think what happened was the evidence of Bitcoin was the limited supply. When you limited the supply, as they did, then you were just looking for 21 million millionaires around the world that would want to buy one Bitcoin. If you can find those guys, then you're probably in a good supply-demand relationship right there. So he did the math from that angle as well. Interestingly, as Warren and Charlie, they thought it was horse manure. I think anybody from a dollar-centric kind of perspective couldn't wrap their hands around Bitcoin because they thought to themselves, never going to replace the dollar. And I don't think the Bitcoin will ever replace the dollar in my lifetime, and maybe not my kids' lifetime. But there are people that live in emerging market countries that have seen their financial system fail, Argentina being a case in point twice. And I made the argument that I think Bitcoin has a lot of value for people in unstable financial systems, Lebanon, Nicaragua, wherever your case may be, and this woman came up to me and she goes, that's exactly the reason why my family owns Bitcoin. They had lost their fortune twice in Argentina when the banks went to zero. She goes, and we get on our feet and we make money back and stuff like that. But after the second time, we said, maybe we don't put everything in there back in the bank again. And you can't put it in gold bars, right? And, hustle that out of the country. So she goes, people that have lost fortunes in unstable economic systems, Bitcoin makes a lot of sense. And so Bill, his analogy was, it was, bit gold, it was just gold. Bitcoin was gold. And I didn't understand, maybe you can help me with this with Jake and Toby. I didn't understand, and this was kind of argument that classic value guys, if it doesn't have cash flow, it can't be valued. There has to be cash flow. Well, there's a lot of real estate that doesn't have cash flow, but people make a determination on value. A Van Gogh painting doesn't have cash flow, but people make a determination of value. Bitcoin doesn't have cash flow, but there are people making a determination of value. So I think if you've got the supply demand and you got the demand and supply figured out rightly, and you've calculated that thoughtfully, it doesn't have to have cash flow to make the market value or the price of that thing go up. We see it happening all the time. So I don't know. Count me as not an atheist, not a diehard Bitcoin bull, but I can see both sides of the argument.
Yeah, I think probably the argument for non-cash flow valuation would be like borrow from the Austrian School of Economics of like subjective value theory. I think where that gets a little more tenuous is like, okay, that is subject to humans' wants and needs and the job to be done that thing is doing for you. And if you look at what like the next thing that it could do if it wasn't doing like use case number one, which was protect you from hyperinflation, it's a pretty far drop off to basically zero. There's like no real marginal value from it. But you have to be comfortable that people are still going to want it in however long your holding period that you're planning. And with something like Bitcoin, like if you use kind of Lindy effect ideas, like, I don't know, whatever, it's been around 15 years or so, maybe if you were only halfway done with the life of it, I don't know, like these things are, it goes into the too hard pile for me. I am also very sympathetic if I didn't have the US dollar as a good technology for transferring value for me living in the US. But
you said something very important, and that's the Charlie Munger, which is if it's too hard to figure out, put it in the too hard pile and move on. And I could save myself a lot of time. Now I've lost opportunities too, and you could have said it had you stuck with it, stuck with it no matter how hard it was to figure out. But I can make some pretty good money on things that are relatively within my scope to figure out. If I look at it and I struggle with it and I struggle with it and I struggle with it, I just got to move on, And I didn't say, Bill, you're wrong. I just said, I can't get comfortable here. It's not in my bailiwick. And he looks at me and he goes, you're an idiot. I can't believe you don't own Bitcoin, And I go, I know, Bill. I mean, I didn't get every one of them, but we got the Amazons and, we got the Nvidias and, I never, who would have ever thought we bought Nvidia in the summer, early fall, before we knew that ChatGPT, we knew stuff was going on in AI, right? And we knew that was coming. We had no idea it was coming November. And, the market puked all those growth stocks that year because when interest rates go up, the robots basically just shorted the Russell 1000 growth and everything was flushed down the toilet. And there was Nvidia at 160, which I never thought I'd ever see at a price which I'd never, to relative value. And we just kind of, we backed it up and said, let's take a full position. And now, 2 years later, it's 6 times.
Might have been an okay idea.
That's my Bitcoin. That's enough Bitcoin for me right now. That's been a good ride.
Well, congrats on that one, Robert. We're coming up on time. If folks want to follow along with what you're doing or find your latest books, how do they go about doing that?
Well, Amazon is, the default engine. They've got, all the library up there. They can follow what we're doing at Equity Compass. It's www.equitycompass.com, and hit the Global Leaders page. You can look at all my commentaries. You can look at my past commentaries. You can look at our track record, and go at it that way. So, that's both the practitioner side as well as the the writing side is freely available. And let me just say right off the top of the bat, I didn't invent anything new here. There's nothing new. Warren says, pick your heroes, and if you pick the right heroes, just figure out everything you can about these smart people. And so I picked Warren, and then Charlie made a lot of sense, and then hanging out with Bill Miller. So you kind of find these people that are really, really smart. And what you do is you just read everything you possibly can about these people, and you read what they're reading. I learned more by reading what Bill was reading and what Charlie was reading. Warren didn't read a lot of books, too much.
10Ks.
That not like Charlie did, but you just got to find the right people. And even Charlie and Warren said, we didn't invent anything new. We just basically tried to figure out what worked, and a lot of smart people were doing this type of stuff. And so I don't think it's as hard as people make it out to be. But once you do write it down, and once you do absorb it past a Wall Street Journal article, past a magazine article, past something like that, when you really absorb it over a multi-year period of time, it becomes part of your psyche, it becomes part of your DNA. And then when you look upon the markets, you don't get disheveled as often. So, as people say, thank you so much for the book. And when I get these links and stuff like that, I said, we were both fortunate to have great teachers. And I was most fortunate to have great teachers. And all I did was spend my life trying to figure out how these guys got so smart and just imitate them, just figure out what they're doing and keep doing the same thing. That's all it was, really was.
I think you've lived well with the Basho quote about seek what they sought, not what they found.
Yeah, exactly right. Exactly right. Well said. Well said.
That's great advice. Thanks so much, Robert.
Thanks, Robert.
Guys, it was terrific. Toby and Jake, what a fun time. I love the give and take. You guys are well versed, and really just a lot of fun to have the conversation. I certainly wish you the best, and thanks so much for the invitation.
Pleasure.